Question number 11. The sales turnover and profit during the two periods were as follows. So you have to find out the PVR as well as the sales required to earn a profit of 5 lakhs, desired profit, fixed desired profit case. The profit when sales are 10 lakhs. That means you have to calculate the profit. These are the three. You have been given period 1 and period 2 details for these two periods, and the information are sales and profit. So if two periods are given, PVR is equal to difference in profit divided by difference in sales. Is that okay? Clear? In percentage. The difference in sales and difference in profit, 10 lakhs and this is 2 lakhs. So the value being 2 lakhs by 10 lakhs, 20%. Now to make you understand how do we get this, sir? What is the formula for PVR? Difference in profit divided by difference in sales. Actual normal formula being what? Contribution by sales. In case of MOS, what? Profit is equal to contribution. Am I right? So profit divided by MOS sales is also PVR. Profit by MOS. Because the profit is nothing but contribution for the incremental sales. Margin of safety is nothing but incremental sales beyond the BEP. Again, denominator is also sales and numerator also profit. Profit is equal to the contribution for the MOS sales. This is nothing but contribution for the MOS sales. So contribution by MOS is equal to the PVR only now. C bar sales. C bar sales. So you can understand the table here. What's that? The relationship among the three will be same. So you can calculate this way. PVR is nothing but contribution by sales, or PVR is nothing but fixed cost divided by sales. This 10,000 is nothing but what? Fixed cost, and this is nothing but BEP. The relationship seems to be same. So you can do this way also. Fixed cost divided by BEP also what? PVR. In case of MOS, the relationship between these two, this 6,000 is nothing but profit divided by the sales for the MOS being MOS sales, or C bar yes. Now whatever the mode may be, you can calculate. Main thing that you have to understand is the MOS is nothing but incremental sales or sales beyond BEP. Any sales beyond the BEP, okay, we don't have the fixed cost. So if you want to find out what is the incremental sales, I'll just use it here between two options. Probably I may consider these two plans. This is one first estimation, this is the second estimation. If you want to differentiate these two, sales 40, from there it is 50, means incremental sales being 10,000. What about the incremental profit between these two? 4,000 rupees. Okay. What about the incremental fixed cost? No, sir, we don't have the incremental fixed cost. So automatically the difference in profit becomes the contribution. For the incremental sales, the incremental profit is nothing but the contribution. So incremental sales is nothing but difference in sales. Incremental contribution is nothing but difference in profit. That's all. Is that okay? So difference in profit divided by difference in sales is nothing but C bar S only. C bar S only. Hope now you'll be able to understand how do we understand that formula also here. Of course, you understand the logic, but you no need to mug up. But once you understand and keep this idea in your mind, you can do it faster. Even though it goes out of your memory, you can guess it. The formula can be guessed. Yeah. Hereafter, I'm going to solve using the formula basis. And in case of fixed desired profit, what is the formula? Sales to earn fixed desired profit of rupees 5 lakhs. What's the formula? Fixed cost plus fixed desired profit divided by PVR or divided by contribution to sales. Okay. Fixed cost, we don't have the fixed cost. How can we calculate the fixed cost? Okay. Sales into PVR. What is this? Contribution. Sales into PVR is the contribution. From the contribution, if you subtract the fixed cost, you will get the profit. Or if you subtract profit, then you will get the fixed cost. Sales into PVR minus fixed cost is equal to profit. Or I can transfer the P to the other side and F to the other side. Fixed cost is equal to S into PVR minus P. Else you can have the format sales minus variable cost contribution. From there fixed cost is subtracted to get the profit. And PVR in this case being 20%. If this is 100, contribution is 20, variable cost is 80. You can take one of the data, probably period 1 data. I can take the period 1 data. If I take the period 1 data, the sales for the period 1 being 20 lakhs, profit for the period 1 being 2 lakhs. 80% of the sales being the variable cost, that may be around 16 lakhs. Contribution should be 4 lakhs, and your fixed cost being the difference between these two, balancing figure. So this is 2 lakhs. Okay, you can get the tabular model or get the fixed cost in tabular model also, or you can use this formula also. If you use the formula, sales being 20 lakhs, PVR being 20%, profit for the period number 1, you can take any one of the period sales, either it may be period 1 sales or period 2 sales, you will get the answer without any problem. So 20 lakhs into 20% and period 1's profit being 2 lakhs, if I subtract, then also you get the 2 lakhs. Sir, can I use the period 2 data, sir? Yeah, of course, if you use period 2 data, by the time also you will get the same fixed cost here. So the sales being 30 lakhs and your profit being 4 lakhs. And out of the sales, variable cost is 8%, 20% is being contribution. So 80% is 24 lakhs and 20% is 80% is 24 lakhs and the 20% is being 6 lakhs. So the difference between these two, 22 lakhs. You will get the same value. So you can find out the fixed cost using the period 1 data or period 2 data. There will not be any harm. So you can now proceed here to solve this illustration. Here, fixed cost is 2 lakhs. Fixed desired profit is 5 lakhs and your estimated PVR being 100%. Now what is the value? Is it 35 lakhs? Hope you will be now able to understand the sales required to earn the desired profit in this case is 35 lakhs. And the last question is, if the sales is 10 lakhs, what is the profit? For the calculation of profit, this is the formula. Profit is equal to sales into PVR minus fixed cost is the formula. Okay. So, profit is equal to sales into PVR. This is the contribution minus fixed cost is subtracted. Sales being 10 lakhs, PVR being 20% and fixed cost being 2 lakhs. So 0. Then this 10 lakhs is nothing but BP. Of course, you can solve using the tabular model also. Sales being 10 lakhs and what about the variable cost? 80%, 8 lakhs. Contribution 2 lakhs and your fixed cost is 2 lakhs. So naturally your profit is 0. You can use the tabular model or formula model. So I have given 3 formulae here. Formula number 1, formula number 2, formula number 3. Apart from that, to find out the missing data of fixed cost, we use this formula also. And I already explained the understanding of the formula also in the previous classes in detail. Clear? Come on, make a note of it. Now, shall I move on to the next one? Try the next illustration, make it faster. Now, question number 12. Online students, if it is clear, text me so that we'll move on to the next one. A company sells its products at 15 rupees per unit. In a period, if it produces and sells 8,000 units, it incurs loss 5 rupees. So, period 1. Okay. Sales 15 into 8,000. How much is that? 1,20,000 rupees. What about the result in this case? You face loss of rupees 5 per unit. 8,000 into 4, 5 rupees, 40,000 loss. If the volume is raised to 20,000 units, okay, for the next period, assume the number of units sold being not 8,000, but it is 20, then there's a profit of rupees 4 per unit. 20 into 4, 80,000 will be the profit. Sales will be 20,000 into 15 rupees per unit, 3 lakhs. Yes, come on. Find out the break-even point, PVR, break-even point and all. Come on, make it faster. So the formula for PVR in this case being difference in profit divided by difference in sales. Tell me what is the difference in profit? So 1,20,000 will be the difference in profit. Minus 40 becomes 80 means incremental profit being 1,20,000. Incremental profit being 1,20,000. Incremental sales being 1,80,000. So 2/3 of your sales will be the PVR. To find out the BEP, I am in need of fixed cost divided by PVR. To find out the fixed cost is equal to sales into PVR, which is the contribution. Contribution comprises two items, one is profit, another one is fixed cost. But if I subtract the profit, I'll get the fixed cost. Okay, you can take any one of the periods details. So now I'll start with period 2 details. 3 lakhs is the sales in period number 2 and PVR here being 2/3. And profit for the period 2 is 80,000 rupees. Hope the fixed cost in this case is 1,20,000. Am I right? Now for BEP, 1,20,000 is a fixed cost. We found out in a separate working note here. And divided by PVR, PVR being 2/3, 2 divided by 2 into 3. 1,80,000 rupees is the BEP. 1,80,000 is the BEP. Shall I move on to the next one? Make it faster. Make it faster. Online students, come on. I got the message only from Archu. What about the rest? Make it faster. Yeah, Uday Sri, Valli Ammai, Gayatri, Sureka, Srividya. Make it faster. Make it faster. Let's move on to the next illustration. Come on, try this yourself. Make it faster. Try this. Don't refer the answers. Now, from the details given below, sales and total cost is given for the PVR. Difference in profit divided by difference in sales into 100. Sales and total cost given. I need the profit. So from the sales, total cost is subtracted to get the profit and loss. For the first 6 months, it is 2 lakhs. For the second 6 months, it is 4 lakhs. So the difference being 4 lakhs for the sales and 2 lakhs for your profit and loss. And difference in profit 2 lakhs, difference in sales 4 lakhs, so 5 lakhs, 5 lakhs. Then if you represent in percentage, it is 40% or 0.4. Now sales required to earn 5 lakhs. Sales to earn 5 lakhs. How will you get this? Fixed cost plus fixed desired profit divided by PVR. I don't know fixed cost. Fixed cost in this case is equal to sales into PVR. Sales into PVR is the contribution. From that, if I subtract the profit, I will get the fixed cost. If I subtract fixed cost, I will get the profit, vice versa. So I am going to subtract the profit here to get the fixed cost. I may take first half 6 months here. So here 10 lakhs is the sales for the first half year. PVR being 40%. Profit for the first half year being 8 lakhs. Now profit 2 lakhs. Profit 2 lakhs. What's the ultimate value? 2 lakhs is for half year. Then what about the fixed cost per annum? You have to multiply with the 2 half years, so 4 lakhs is the fixed cost. Sometimes you may get twisted because of this reason. Check whether the details is for the year or half year. If it is being the half year, you have to find out the fixed cost for the full year. Then you can proceed here. So fixed cost in this case being 4 lakhs. Your fixed desired profit estimated being 5 lakhs. PVR being 40 percentage. 40 into 100. How much is that? 22,500? 22.5 lakhs. 22.5 lakhs. And profit when the sales are 20 lakhs. So profit is equivalent to sales into PVR minus fixed cost. Here the sales is given like 20 lakhs and PVR being 40 percentage. And fixed cost in this case being 4 lakhs we already found out. So ultimate profit in this case being 4 lakhs. Is that clear? Clear? Do you have this sum in your book? Okay. You have. You don't have. Group 2 or group 1? Group 2. You get the book or not? You didn't get the book, that's okay. I think group 2 students will have this illustration in their text. Group 2 students. CMA group 2. CMA group 2 students will have. CA group 1, group CA group 2 and CMA group 1 may not have this illustration. Anyhow, you can learn this for advanced understanding. Okay. Now, until now we have found out the BEP if we have only one product. Here we will have multiple products, 2 or 3 products. How can we arrive the BEP? Right. Let's try to solve this illustration so that you will be able to understand this one. This one is exclusive for CMA group 2 as well as CMA group 3. For CMA group 1 costing paper, CA group 2 cost and management accounts paper. For that, this will be additional learning. Additional. Okay. This is must. Okay. This is must. Clear? 14th and 15th, 2 illustrations are included here. Those 2 illustrations are must for CMA group 2, CMA group 3 and CMA group 1, CA group 2. These are the additional learning. ABC Limited manufactures 3 products P, Q and R. The unit selling price of these products are this much. Corresponding units variable cost also be given here. The proportions quantity wise in which these products are manufactured and sold being this much, this is the ratio. So you have three products P, Q and R. Sale price of P being 100, Q being 80, R being 50. Variable cost in this case being 50, 40, 20. Contribution here being 50, 40 and 30. Actually, this is the PBR for P. This is the PBR for Q. This is the PBR for R. But I am not selling only one product. I have all the three products. In that case, you can consider a batch of quantities sold. A batch of quantities sold may be a small portion of P, Q, R will be included. Or as per their sales mix will be taken. Here the sales mixture is given which is 20, 30 and 50. Okay, what does it mean? 2 units of P as well as 3 units of P, Q and 5 units of R are sold. That's the logic you have to understand. Clear? Now, how many units you can sell? 2 units of P, 3 units of Q, 5 units of R. A set of 10 units if you sell, it consisted of 2 units of P and 3 units of Q and 5 units of R. 5 units of R. Then what about the contribution of one set? What is the contribution of set? One set. The contribution you will get in set being 100 rupees you will be getting from P, 120 you are getting from Q, 150 you are getting from R. Contribution per batch being 370. Okay, by selling one batch of PQR where P is having 2 units, Q will have 3 units, R will have 5 units. In that bunch, if you sell, you will be getting 370 being your contribution. Now to attain your break-even point, how many bunch or batches you have to sell? So you know that BP in units, okay, in units is equal to fixed cost divided by contribution per unit. But here I am going to replace the unit rather than unit, BP per batch, contribution per batch. That's all. So you can state this way. Now what happens? Fixed cost being 14 lakhs 80,000 rupees. Contribution per batch in this case being 370. How many batches you have to sell to break even? 4,000 batches you have to sell. 4,000 batches means how many A, how many B, how many C you have to sell? 2 units of A, 3 units of B, 5 units of C. As per their proportion you have to sell. So 8,000 units of A, 800 units of 8,000, 4,000 into 2. One batch consisted of 2P, 3Q and 5R. Such a way 4,000 batches are saleable. 4,000 batches means that every batch consists of 2P, 3Q and 5R. So then 4,000 into 3, 12,000. 4,000 into 5, 20,000. You can cross verify. You can cross verify if you want. What is the contribution you are getting? A, B, C. 8,000 units are sold. I'll just put it here. Units contribution. Contribution being 50 rupees per A, 40 rupees for Q, and 30 rupees for C. Okay, PQR. No, this is PQR. Okay. Come on, get me the total contribution. Number of units sold in contribution per unit. Here the value being 4 lakhs. Here 4.8 lakhs. This is 12,000, right? 3 into 12,000. Okay. 5 into 20,000. Okay. This will be 4.8 lakhs. Here 6 lakhs. the total being 14.8 lakhs. From there, if I subtract the fixed cost 14.8 lakhs, then your profit and loss being 0. Your profit and loss being 0. Hope now you'll be able to understand this. If it is clear, text me. Now, let's move on to the question number 15. Also applicable for the CMA Group 2 as well as Group 3. For CA as well as CMA Group 1 not required. But anyhow, I request you to have wider knowledge so that this chapter will be very convenient to score good mark in your exam. One of the comprehensive illustration. A company manufactures radios which are sold at 1600 per unit sale price. Total cost composed of 30% direct materials, 40% direct wages, 30% overheads. Right. An increase in material price by 30% and wage rates by 10% is expected in the following price. This is what about the current rate. Coming years, material price also going to be increased, wage rates also being increased. As a result of which the profit of current selling price may decrease by 40% of the present profit. Whatever the present profit we have, because of the price hike in material as wage rate, your profit decreases from 100 to only 60 here, 40% decreases. You are required to prepare a statement showing current and future profit at present selling price. The present selling price being 1600. Okay, if I sell the product at 1600, what is the current profit, and later on what could be the profit? Definitely the current profit may be 1000. The revised profit should be only 600. It's 40% down. Right. We try to finish up this first of all. Sales 1600 minus total cost. Total cost comprises direct material, direct labor and overheads, which is 30%, 40% and 30% total cost. Otherwise, I assume the total cost being X. Total cost being X. So the direct material should be 0.3x. Direct labor should be 0.4x. Overhead should be 0.3x. The total cost being x. Okay. That will be x. Now, if you add the profit with this, I assume the profit being y. This is total cost. Profit being y. Clear? Or 1600 minus x, that way also you can show. You can show this way also, no problem here. 1600 minus x. That value also be accepted, no problem here. Clear? In both the way you can show. Is that okay? So I'll go with the solution given in text. So it is y. Total cost is x. Profit is y. Sales is total cost plus profit. Otherwise, x plus y is equal to 1600. In case of revision in the coming year, material cost increases by 30%. Wage rate increases by 10%. Because these two increase, the profit at the current sale price, the same 1600, if you fix the sale price, your profit decreases by 40%. Now revised. We continue to fix the sale price being the same 1600, but material cost being 0.3x plus 30%, 0.39x, and labor being 0.4 plus 10, 0.44x. Overhead, there is no change in overhead, 0.3x. What about the total x? Total cost 1.13x. 1.13x. What about the profit here? From the existing profit, 40% will decrease, otherwise y will be 0.6y. 0.6y. Is that clear? Now we got the simultaneous equations, like then you can solve this to get the final answer. Right. X plus y in the original scenario 1600. Okay. In the revised scenario, x becomes 1.13x total cost and profit being 0.6y, which is equivalent to the same selling price. Selling price remains same. Okay, what can I do? I can simply multiply. Okay, with the 0.6. If I multiply this with 0.6, I can simply cancel the equations. Equation 1 and equation 2. If I multiply 0.6 with this, so 0.6x plus 0.6y is equal to, come on, 960, am I right? Equation number 3 being 960. 1600 into 0.6. I multiply 0.6 with the equation number 1. Now I am going to subtract the equation number 3 from 2. Automatically what happens? These two are cancelled. 1.13x minus 0.6x being 2 minus 3. 2 minus 3. How much? 0.53x is equal to 640. Get me x here. 640 divided by 0.53. What is the value? 1207.5. This is what about the total cost. Is that okay? So what is the requirement? You are required to prepare statement showing current and future profit at present selling price. You can now write completely. You can redraft this. For the current scenario, sales price 1600, total cost being 1207.5, and profit will be the difference between these two, 392.5. Break this value. 1207.5, out of which 30% is for the direct material. Come on, get the value. 362.25, 40% 483, again 30% is 362.25. And what happens in case of revised, sir? We have not revised the sale price, that remains 1600, but direct material increases by 30%, so you have to add 30% with this, otherwise 0.39x, 0.39 into 1207.5, that way also you can calculate. What is the ultimate value? 470.93, I can round off. Next one being 0.44x, 0.44 into 1207.5, 531.93, 31.30. Next, this will remain same, 362.25. Then total cost becomes 1364.50. The revised profit being 235.50. It means there is decrease in estimated profit from the earlier by 40%. From the earlier profit, if you subtract 40%, you will be getting the revised price being profit being 235.5. Clear? Now let's move on to the next question. How much selling price should be increased to maintain the present rate of profit? What is the present rate of profit? Okay. So profit percentage, profit by sales. Profit currently 392.5 divided by 1600. What is the percentage? 24.5%. It means if sales being 100, your cost and your profit should be 24.5. Otherwise, I will do this way. Cost, add the profit, then you will get the sale price, the profit being 24.5 on sales. If sales is 100, profit should be 24.5 currently. 75.5 will be the cost. This is the current scenario. In the reverse scenario, I know the total cost. The total cost in the reverse scenario being 1364.5. 75.5 is equal to 364.5 means 24.5 should be how much? 442.7. If I add this, the revised sales price being 1807. Am I right? So from the existing sales price, how much you are increasing? 207. Is it correct? Okay. 207.2. Am I right? But in the text, answer is totally different. Here it is clear present rate of profit. But in text, I have solved this using present amount of profit. Present amount of profit means what is the shortage in profit? Come on. 157. This is the shortage in profit. I just added that 157 with that. So present amount of profit is different. Present rate of profit is different. Present rate of profit is nothing but whatever the earlier cost with that 24.5 on cost is added. And similarly, in this time, the cost being 1364.5 means I have to add 24.5 out of 75.5 will be the revised sales price. The same rate of profit is earned. But in the text, it is solved using the present amount of profit. Present amount of profit. Present amount of profit means earlier I got 392.5. now it is reduced, but I need to get the same 392. It means I need to get another 157 excess. Then you can simply add this one with the revised price 1364 point or 1600 is the existing sale price. With that I had to add 157, so 1757 is the revised price. This is how we can get the answer. Okay, first approach is present rate of profit, second approach is present amount of profit. Clear? Clear? Text me. So I got the message only from 3 of you. Let's move on to the next one. This entire set will be applicable for the CA Inter as well as CMA Inter Group 2. But anyhow, CMA Inter Group 1 students also in costing paper, you can have the background of this knowledge. Okay. Now, the main part of this marginal costing is application. Application for the management's decision making purpose related to various aspects including profit planning, like determining indifference point, sales mix, limiting factor, elimination of your product, accept or reject, shutdown point or continue, make or buy, plant merger, expansion, evaluation of alternative choices. These are the cases you have to understand. Is that okay? I think up to 13th illustrations are common. 14th is comprehensive illustration for CMA Inter Group 2 as well as final students. But anyhow, you have knowledge to the extent of final, so that you'll be able to handle your basic level illustrations easily. This 14 and 15 not available in CA Inter as well as the CMA Inter Group 1 paper. This sum is not available, you just copy it, no issues. Let's start with the first illustration. So, we have completed the basics of marginal costing and how can we apply this technique in various cases, and we use that for deciding if there is any change in fixed cost, variable cost, how far this will have impact on the profitability, MOS and BOE, BEP and all. Hereafter, we are going to apply that marginal costing technique for our study. Let me start with the first one, indifference point, replacement decision and suitable machines. Let's start with the first question. Two businesses, Y Limited and Z Limited, sell the same type of product in the same type of market. Their budgeted profit and loss accounts for the coming year as follows. Sales per unit, variable cost and fixed cost we have been given. You are required to calculate PVR. You have to calculate the PVR. So, how will you calculate the PVR? PVR is equal to C bar S into 100. Now, you need to get the contribution. Contribution is nothing but the difference between sales minus variable cost, 30 and 50. For Y, 30 by 150, 20%. For Z, 50 by 150, one third, or 33.33%. We got the PVR for Y Limited as well as Z Limited. Second question, the break-even point of each business. You have to find out the BEP. BEP in units is equal to fixed cost divided by contribution per unit. So you have to divide the fixed cost by contribution. 15,000 divided by 30 rupees, 500 units, and here 700 units. If you want to represent the same BEP in rupees, you have to multiply with the sales price. The sales price here being 150. If I multiply 150 with 500, 75,000 for Y. For Z, 700 into 150, 1,05,000. We got the answers here. The very, very important question for this particular illustration is all about this one. Especially, fourth one is most important. Third is also very similar, right? Sales volume to which each business will earn 5,000. Desired profit. For desired profit, what is the formula here? Sales to earn. Sales to earn 5,000 rupees. Fixed cost divided by plus fixed desired profit by contribution, or simply PVR also can be used. For Y Limited, fixed cost 15,000, fixed desired profit 5,000, PVR for Y being already we found out, which is 20%. 20%. 1 lakh. Am I right? In case of Z, fixed cost 35,000 and fixed desired profit estimated here being expected being 5,000 divided by PVR. In this case, the PVR being 1/3, 1,20,000. 1,20,000. Clear? Up to now, I just applied the formula to get the answers. But it is not our intention, as this topic is for decision making purpose. It may be a management technique for the decision making purpose. Yeah, interesting tool for the decision makers. So as it's a tool, now you use the tool to get the data and you need to interpret whether the Y Limited is better or Z Limited is better, which limited you want to invest in all. So that question may be asked for fourth and fifth case. Okay. Now, both are the same. Would you like to catch auto or car, taxi for your travel? Depends. Okay. Maybe auto, it costs us around 20 rupees per kilometer or 12 rupees. Okay, we'll have 12 rupees per kilometer. And in case of car, it may be 16 rupees per kilometer. Okay. What happens if one traveler wants to travel? The total cost for a kilometer being 12 rupees. In case of car, it is 16 rupees. And what about the cost per passenger? 12 rupees and 16 rupees. If two passengers are traveling, 12 rupees per kilometer, the same. In case of car, 16 rupees. But as two passengers are traveling, you can share the 12 rupees. Each cost us 6 and here 8. And third one being 12 rupees, 3. What happens? 3. 3. Yeah, of course, you can travel 3 also in the auto. Here, 16. The cost per passenger in this case being 4, here 5.33. In case of 4, you have to catch up 2 autos. Then for every auto, 12 rupees for 2 auto, you have to pay 24 rupees for 4. It cost us how much? 66 rupees per head. Rather than that, if you catch up the car, you spend still 16 rupees only. For the 4 passengers, 16 means it's naturally 4 rupees. From this, it is very clear. Up to this point, choosing auto is better. After this, choosing car is better. Both are for the travel purpose only. Now the requirement is, how can I reduce the cost? By reducing the cost, the profitability may be increased. So it's very simple. Go for car or auto. In case of auto, what happens? Running cost is very less, 12 rupees only. In car, running cost is also 16, but sometimes later it may be cheaper. But initial investment for the auto, it may be 3 lakhs or 4 lakhs. But in the case of car, it's anywhere between 4 to 8 lakhs. Higher the fixed cost, lower the running cost. That's a combination. Always remember, 2 different products are there. 2 different machines are there. One machine will have more fixed cost with lower variable cost. Another will have lower fixed cost with higher variable cost. In that combination, if you have been given 2 choices, now it's your duty to select between these 2 the most suitable for you. Just similar to the break-even point. What is the formula for break-even point? Fixed cost divided by contribution per unit. Here, at what level Y as well as Z will be giving me the same cost? Because of moving from Y to Z, what is the extra cost you are spending? 20,000 rupees. Because of moving from Y to Z, okay, what is the benefit you are getting extra? For every unit, you are getting 50 rupees extra benefit. Am I right? Difference in contribution. So from this, it is very simple. If you want to shift from Y to Z, you have to spend 20,000 rupees extra. Because of shifting from Y to Z, your savings will be 20 rupees per unit. For every unit, if you are saving 20 rupees, how many units you have to sell to save that 20,000 rupees? Save the 20,000 rupees. So 20,000 divided by 20 rupees. How many units? 1,000 units. So if you sell 1,000 units, the total cost between both the product will be the same. Similar to this one. Okay, you can now apply this. You can verify for 1,000 units. In case of Y as well as in case of Z. Sales being 150 rupees, or you can directly take the contribution. Contribution being 30 rupees per unit into number of units being 1,000, 30,000. In Z, 1,000 into 50, 50,000 rupees. From there, you have to subtract the fixed cost. For Y the fixed cost is 15, for Z the fixed cost is 35,000, the ultimate result being same here. Clear? This is called indifference point. This is called indifference point, otherwise sometimes named as cost break even point. This will be named as cost break even point. Indifference point is the point where the total cost as well as total revenue will be same for two given alternatives. Similar way, you might have studied in financial management indifference point, especially capital structure indifference point. The same logic will be applicable here also. It will be having wider application in your CMA group 2. Not only here in OM, almost 3 or 4 different topics you will have this indifference point applications. So you have to be very master with this. Clear? Now, at which sales volume both the firms will earn equal profits. This is called equal profit is nothing but indifference point. For this, the formula being difference in fixed cost divided by difference in contribution or difference in variable cost or difference in variable cost. Okay. Will I get the same answer? Yes, sir. The difference in variable cost is how much? The difference in contribution is how much? 20. The difference in variable cost is equal to the difference between the contribution. There will not be any trouble here. Okay, you can take one of these two. You will get the same answer here. Remember, between these two, which machine will be suitable for your demand requirement? So it's clearly asked in the question number 5. State which business is likely to earn greater profit in condition of if we have heavy demand or low demand. It means you are pretty sure that up to 2000 units, Y and Z will give the same profit. That's called indifference point. If the sale is anywhere between 0 to 1999 units, or if the sales is more than 2001, at this point X and Y will give the same profit. Okay, sir. If the demand is not 2000, less than 2000, which is better, Y or Z? Can I go for auto or taxi or van or bus? Only 1 or 2 travel, then auto is better. Then if you want to go for 4 or comfort, then car is better. Or around 10 or 12, then you can go for the minivan and van, and even you can travel by bus. The same, the size matters. If you go for the bus, huge initial fixed cost will be there, but their running cost is very less. The per kilometer travel, if you go for bus, no, they charge around 50 rupees per kilometer. Though it may be 50 kilometers, 50 can be accommodated. So per passenger cost may be 1 rupee per kilometer. But in case of auto, they demand 12 rupees, but only 3 can maximum go. So automatically 12 by 3, 4 rupees will be the per passenger cost per kilometer. The same happens if you are manufacturing and selling 2000 units only. Either you can go for Y limiter or Z limiter, you will be getting the same cost. But if the demand is not so much lesser, which is better? Lower the demand, lower the fixed cost is the suitable. Lower the fixed cost means between these two, which is good, Y will be suitable. So low demand will be suitable for, when the demand is low, suitable for low fixed cost with high variable cost. In case of heavy demand, high fixed cost with low variable cost will be the suitable one. So here fixed cost is high, variable cost is very, very lesser. So this one will be suitable for Z limit. Okay, I'll give that one here. Okay, now fixed cost, variable cost per unit. High fixed cost, low variable cost per unit, suitable for high demand. And low fixed cost with high fixed cost, variable cost per unit will be suitable for low demand. Suitability. Okay, clear. So here I have given indifference point calculation we have completed. We have studied the suitable machines also. Clear? Yeah, come on, finish up copying this. No, it is 1000 units, right? Sorry, I made a mistake here. Okay, that's what about your question, right? Indifference point is 1000. Less than 1000 will be suitable for Y. More than 1000 is suitable for Z. Uday Street. Now, I hope you will be able to now understand this. Stand corrected. Clear? Text me. Now let's summarize the points what we have discussed. Indifference point, or it may be otherwise named as cost break-even point. Two alternatives may be given, so that the difference in fixed cost divided by difference in variable cost will be considered here. Main point. Second point, to decide whether at what level it is suitable, you can depend on this uh, theory also, this points also. Clear? Now let's move on to the next one. Sales mix. Okay. The total budgeted sales, that is 100% of sales per month being 60,000 rupees. Okay. Accelerate Company Limited manufactures and sells 4 types of products under the brand names of A, B, C, and D. 4 products are sold. where the total sales comprises in this ratio 33 1 by 3 for A, 41 2 by 3 for B, 16 2 by 3 for C, and 8 1 by 3 for D. And variable cost is also there, and fixed cost. Calculate the break-even point for the products on overall basis. You cannot calculate for A, B, C, D separately. Break-even point for A, B, C separately is not going to be calculated. It's a combined one. Already we have seen, right? Now try to find out the contribution for overall sales 60,000 rupees. Now, what are the products we have? Product A, B, C, okay, A, B, C, D, total. Okay. What is the total here? Percentage of sales being 33 1 by 3 percentage. Here 41 2 by 3 percentage. 16 2 by 3 percentage. 8 1 by 3 percentage. Out of 100 rupees of sales, each and every product will comprise this much sales proportion. This is sales proportion. Now sales in rupees. Sales in rupees. 60,000 is the total sales. Out of that, A being 33 1 by 3, 20,000. And B being 10,000. 10,000. C being 5,000. C being 5,000. D being 5,000. B being 25,000. Now, sales minus variable cost, you'll get the contribution. You'll get the contribution. The proportion of variable cost for these products on selling price is given. For product A, 60% on selling price is the variable cost. If the sales is 100, variable cost is 60, contribution 40. For B, 100 rupees sales, variable cost 68, contribution 32. For C, 100 rupees sales, 80 rupees variable cost, contribution 40 rupees. Sorry, 20 rupees. In case of D, 100 rupees is the sales and variable cost to be 40% on sale price and contribution 60. Now come on, find out the contribution for all the products here. 8,000. 8,000. Here also 8,000, right? Next, 2,000. 3,000. What is the total contribution? 21,000. 21,000. From that you can subtract fixed cost 14,700. Fixed cost cannot be subtracted for every product separately. It should be subtracted collectively. Then your profit in this case be 6,300. This is the present scenario. Clear? Second question B. Also calculate break-even point if sales mix is changed as follows. The total sales per month maintaining the same means the same 60, but mix is totally different. Let's see here now. The revised mix being A 25 percentage, B 40 percentage, C 30 percentage, and D 5 percentage. Total being 100. In terms of rupees sales, the total sales remains the same 60, but the mixture is changed. Earlier 41 2 by 3 percentage sold for B, but now it is only 40. A also reduced. Instead of that, C is increased from 16 2 by 3 to 30 percentage. D also decreased from 8.13 to 5 percentage only. Now out of 60,000 rupees, 25 percentage means 15,000 is now sold for A, and 40 percentage 24,000 B, and 30 percentage 18,000 C, 5 percentage 3,000 D. From that you can subtract the variable cost, you get the contribution. From that you can subtract the fixed cost to get the profit. Now the relationship between sales, variable cost and contribution for A being 100, 60, 40, 100, 68 and 32. 100 I just copy from the earlier one, right? 100, 80 and 20, 80 and 20. Here 100, 40 and 60. Yes. Out of 15,000 sales of A, contribution 40 percentage being 6,000. For B, 32 percentage on 32 rupees. Otherwise 32 percentage and 24,000. 7,680. 20 percentage on 18,000, 3,600. 60 percentage on 3,000, 1,800. So total contribution be 19,080. 080. Okay. So now what happens? So because of changing the mixture, your contribution is decreasing. So your suggestion is that you should not recommend this changed one. So from that fixed cost 14,700 is subtracted. So the profit is 4,380. Compared to the earlier one, now the profit is decreased. So revised mixture is not recommended. You have to continue with the existing one itself. Also, you have been asked to find out the break-even point. The formula for break-even point in this case being, okay, fixed cost divided by contribution into sales. You can take the total sales and total contribution. So fixed cost here being 14,700, total contribution being 19,080, total sales being 60,000 rupees. Find out the BEP in this case. So 46,266 to 26, 66 to 26. Okay. So this is your BEP. In this 46,226, sales should be in the mixture of 25 is to 40 is to 30 is to 5 ratio, 5% ratio. Only then you will get the BEP. Okay. For this mixture, this will be the overall sales to attain the BEP. Clear? Clear? Come on, text me once it is clear. Make it faster. Now we'll move on to the next content, limiting factor. Limiting factor along with optimum product mix. Right. See, understand that sale price of a product being 100, product A, or it's a type of pen A and pen B, two varieties of pen you are selling in your stationery mart. The pen A costs us 100 and pen B costs us 200 rupees. And variable cost per pen in this case being, in case of A, 60 rupees. Okay. Now, in case of B, 140 rupees. Okay. If a customer comes to you and his need is one pen, come on, tell me which pen do you want to sell to make huge profit or increased profit? Which pen do you want to sell? You want to sell naturally B. By selling A, you will be getting only 40 rupees. By selling B, you will be getting 60 rupees. Naturally, you recommend to sell B only. Otherwise, if your customer demands, I need pen for rupees 1000. Now tell me, which pen do you want to sell? A. Why? A or B? A. Why? For 1000 you can sell 10 pens. Per pen you will be getting 40 rupees, means for 10 pens you are getting 400 rupees. For the same 1000, if you want to sell B, only 5 pens can be sellable. Per pen gives you 60 rupees. For 5 pen, 5 into 60, 300 only you are getting. So this is what about the criteria your customers may demand for their purchase. Then you have to decide based on what. In case if it demands based on the number of units, means sales in units, then your decision will be deciding factor is nothing but contribution per unit. If your customer demands the sales in terms of rupees, your deciding factor is nothing but PVR. So here contribution per unit being 40 rupees for A, 60 rupees for B. So as sales in units is deciding factor, means limiting factor. This is called limiting factor. The need of the buyer is called limiting factor. It limits your decision. Okay, limiting factor. As the limiting factor being the number of units to be sold, for every unit you need to get more. It means you need to get more contribution. So contribution per unit is the deciding factor. So you are now ranking based on the contribution per unit, first rank and second rank. When if the sales in units is the limiting factor, deciding factor being contribution. Similarly, in case of PVR, C bar S, 40 by 100, 40%, 60 by 200, 30% only. For every rupee, you will get 40 rupees profit. In case of A, in case of B, you will be getting only 30 rupees. So if the sales in rupees is limiting factor, your deciding factor is nothing but what? PVR. So you now rank based on the PVR, rank 1 and rank 2. If 1000 rupees is there, and in case of selling A, 40 rupees will be yield on your 1000 rupees. 1000 into 40%, 400 rupees. If you are selling B, 30% on 1000 will be your earnings. Clear? So we may be having some constraints. Within that constraint I have to play. So by satisfying that constraint I need to increase my profitability. So based on the decision criteria of limiting factor, you have to make the decision criteria also. Check the decision criteria. Based on that you can make the decision. Clear? Not only that, sometimes resources also be matter. Resources, probably A is in need of uh, probably A is in need of 2 hours to manufacture. B is in need of 4 hours. Assume that the customer comes to your office, says, "Sir, I'm in need of A and B. Whether it is A or B doesn't matter. Unlimited products I'm in need. Okay, try to supply me whatever the maximum possible you are able to do. You can supply." Then your trouble is you have only 1,000 hours only, or 1,000 kgs only. It may be either material, or it may be labor hour, or it may be machine hour. Those are the resources. Those resources are limited. So in this case I consider that it may be labor hour. Your labor hour limited to only 1,000 hours, where if you want to manufacture A, I'm in need of 2 hours for manufacturing every A. In case of B, I'm in need of 4 hours to manufacture every B. The customer demands me to supply any number of units. So any number of units means how can I make the decision? Just think over, if I manufacture only A using the available hours for the 1,000 hours, 2 hours needed, almost to find it A can be manufactured for every A I'll get 40 rupees. So 40 into 500, how much? 40 into 500, come on, 20,000. 20,000 is our profit. Instead of A, if you go for B, 1,000 divided by 4, 250 units can be manufactured. Per unit gives me how much? Only 60. 250 into 60, you will get 15,000. Then you will make the decision that A is profitable for you to supply. But you need not to calculate this way. There's a shortcut. If the limiting factor being some resources, then deciding factor is nothing but contribution per limiting factor. Contribution per limiting factor. So here contribution per limiting factor. 40 rupees is the contribution for 2 hours per hour, you get 20 rupees. 60 rupees for 4 hours means every hour you will be getting only 15 rupees. Now you can decide based on this rank. This will be the top rank. This is the second top rank. So as you have 1,000 hours, for every hour you will be getting 20. In case of selling A, 1,000 into 20, 20,000 rupees. In case if you sell B, 15 rupees into 1,000, 15,000 rupees you will be getting. So lengthy calculation is shortened here by this way. Contribution per limiting factor is the shortest way to get the decision easily. 3 categories are there. One is sales in units is the limiting factor. Another one is sales in rupees is the limiting factor. Last one being any resources. Any resources means it may be raw material in kg, or some raw material may be in liquid form in liters, limiting factor. Labor hours, limiting factor. Machine hours, limiting factor. Whatever the limiting factor you know. So for those limiting factor, you have to find out the cost contribution per limiting factor. That particular commodity gives you more revenue per limiting factor will be chosen. So understand that here. Sales in unit and contribution per unit. This is limiting factor. This is deciding factor. Sales in rupees, PVR is the deciding factor. Any other resources is the limiting factor. Then contribution per limiting factor is the deciding factor. That's it. Based on that you can take the rank. Clear? Ultimate this one. Okay. Has she taught you something? Okay, clear. Shall I move on to the next one? Now let's try to solve this question number 3. Limiting factor and optimum product mix. The following particulars are extracted from the records of a company Comment on the profitability of each product. Both use the same raw material when total sales potential in units is limiting factor. Second, sales potential in value is limited. Third, raw material is in short supply. Fourth, production capacity in terms of machine hour is the limiting factor. So, four limiting factors. Each and every limiting factor will be calculated independently, not collectively. Assume that only the sales units is the limiting factor. What could be the chosen one? So, let's start with this sales variable cost. You will get the contribution. We have two products A and B. Sales price being 100 and 110. And we have been given direct material cost, direct wages, and variable cost. This is machine hour use, this is consumption of materials. Come on, add up these two. Total cost 24 plus 2 plus 4, 30. And 14 plus 3 plus 6, 23. What is the contribution here? 70, 87. So, for this deciding factor, limiting factor being sales in units, deciding factor contribution per unit. Sales in value is the limiting factor and PVR is the deciding factor. Raw material is the limiting factor. Contribution per kg of raw material to be the limiting factor, deciding factor. In terms of machine hour, then contribution per machine hour is the limiting factor. Per hour will be the limiting deciding factor. So, product A as well as product B. Contribution being 70 and 87. And which is chosen? B is chosen. In the next case, I am in need of PVR. Calculate the PVR here. C bar is 70%, 87 by 110, 70, 79%. So 70% and 79%. If the sales value is limiting factor, by the time also you have to choose B only. By the time also you have to choose B only. Raw material is in short supply. Contribution per kg you have to calculate. 5 kg and 4 kgs are required. Okay. You divide the contribution by number of kgs. 70 rupees for 5 kg means per kg 14 rupees. 87 for 4 kg means 21.75. So 14, 21.75. In this case also we have to choose B. In this case also we have to choose B. Last one, machine hour. Machine hour is given here. In this case, contribution is divided by the machine hours. Contribution per hour. 70 rupees for 2 hours means per hour 35. 87 for 3 hours means per hour 29. In this case, 35 and 29. Only in case of machine hour being the limiting factor, we have to choose A. In all other limiting factor, it's better to choose only B. Clear? So, it's what about the first level of understanding in case of limiting factor. In case of limiting factor, 2 or 3 options are given. Now, you have to decide among the 4 options or 5 options, which is the best options. Even you can rank it. Now, you have decided that A is better. The next one is what could be the profitability as you have chosen A. That's what about the next part calculation. So, we'll see that in the next illustration. Come on, finish up copying this. We'll move on to the next one. Shall I move on to the next one? Now, in a comprehensive limiting factor problem, you have to decide which among the given options is best. Rank that first of all. Rank that based on the limiting factor given. Second one is, if you have been given 4 or 5 products to be manufactured, you have to now rank all the 4 or 5 items. After ranking, you have to decide to what extent you can produce and sell for each and every commodity. That's called optimum product mix. Optimum product mix. Not only that, after finding this, you have to recommend and show it. This is what about the recommended optimum product mix. As this is the best mix as per your recommendation, now you have to find out the profit for your recommended mix. Profit for the above mix. For the above, as per your recommendations. It involves 3 steps. 3 steps. You know that limiting factor could be of what? Sales units, sales rupees, resources. While deciding the sale optimum product mix, you may be given minimum number of quantity to be sold in all the different varieties of material you sell, and restriction not saleable in the market by way of maximum number of units saleable also may be given. So you have to consider these constraints also. Not only deciding based on the limiting factors, sometimes we have been given the other market constraints. Okay, you have 4 products. Product A is non-profitable. What you can do, you stop selling A, rather than you can go for B, C, D. But buyers coming for B expects A should also be purchased from us, but we say we don't have A. They definitely skips buying the B product from me also. That may be adversely affecting. If you are going to a shop, you're supposed to buy the shirt. Okay, so the shirt design is not suitable. Then naturally what happens? You don't purchase the pant also. So once you purchase the shirt, then anyhow you'll go for purchasing the pant. Though the margin in pant may be lower, the shirt may be lower, they want to keep that, so that by selling the pant they can make huge profit. Such a way 4 or 5 products you may have where A is least profitable, yet you need to sell at least minimum 500 or 700 units. Like that's how the statement may be given. Point number 1. Second point, maximum number of units can be saleable in the market as per the previous year's expected demand may also be given, so you cannot sell beyond that. Though product A is most profitable, can I use all the resources for manufacturing and selling the product A itself? No. So definitely it's not possible, because market is not capable of absorbing all the products you have manufactured. Clear? Hope now you will be able to understand this one. So these are the 3 cases and these 2 additional cases. That's more than enough to understand this chapter. We'll start with this one. Limiting factor, and also you have to recommend optimum product mix. Limiting factor, and then you recommend optimum product mix. ABC Limited is manufacturing 3 products X, Y, Z. All the products use the same raw material which is scarce and are available to the extent of 61,000 kgs only. So what is the limiting factor? Raw material is the limiting factor. Okay, we have been given selling price and variable cost. Then automatically you can get the contribution. Come on, get the contribution here. 25 rupees, 30 rupees and 25 rupees. And raw material is the limiting factor. So you have to find out the contribution per kg of raw material. So 25 for how many kgs? For 5 kgs. So 5 rupees per kg. 8 kgs required for 30 rupees contribution. 3.75. And last one is 25 rupees for 6 kgs of raw material. 4.17. From this it is very clear. Okay, this will be the top rank X, and this will be the second top rank, and this will be the third top rank. Okay, first rank, second rank, third rank. So from this it is very clear, you want to sell only product X. By selling product X, you will be getting 5 rupees. As you have 61,000 kgs, for every unit you will get 5 rupees, means you will be getting 3,05,000 rupees contribution. Okay, how many units can be sellable? For every X you need 5 kgs, 61,000 kgs are there. If I divide this by 5, come on, 15,200 units can be manufactured. 15,000? 12,200 units can be manufactured, right? But here, market demand, maximum 5,000. You cannot sell beyond 5,000. If you manufacture 12,200 units, as it seems to be more profitable, market is not capable of absorbing that. So what's the use at all to manufacture maximum? Though excess max gives you more profit, yet all the products manufactured cannot be sellable in the market. To the extent market demand you expected could be manufactured X. Beyond that, if you have surplus resources, can be used for manufacturing the second rank product. Thereafter, you can go for the third rank product. That's the logic here. Hope so you could understand. Come on. Now, I'm going to calculate the optimum product mix. Optimum product mix. Optimum product mix. Raw material available. How much? 61,000 kgs. First, you have to manufacture what? Product X, as it is being top ranker. How many units can be manufactured? 5,000 units. That's the maximum number of units saleable in the market. Beyond that, not advisable. For manufacturing every unit of X, how much of raw materials required? 5 units required. So overall, you have to spend 20,000 kgs of material. Already we have 61,000 kgs of material. Used 20,000 for X for manufacturing X. Balance, we have 41,000 kgs of material can be used for the second rank product. What is the second rank product? Z. So you can go for manufacturing Z. 25,000. Okay. Now what's the value here? 36,000. Now, in case of product Z, the market demand being 4,000, beyond that you cannot sell. For manufacturing every Z, it requires 6 kgs of material, 24,000 kgs of material needed. Already we have 36,000 material. Of course, we are sufficient enough to manufacture all these Z's market demand. So after that, still we have material to 12,000 kgs can be used for manufacturing the least choice product Y also. Y. How many units can be saleable in the market? 3,000 units can be saleable. Into per unit requires 8. So overall 24,000. Then 24,000 is not available here. So what do you have to do? You can do the reverse calculation. Okay, you can do the reverse calculation. Make it 0. The entire 12,000 is used for manufacturing Y. So many units manufactured at where consuming 8 kgs per unit of Y. We are in need of 12,000. Means now what about the number of units? 1,500. So manufacturing 5,000 units of X, 1,500 units of Y, and 4,000 units of Z will be the optimum mix. That mix only gives you more revenue. Beyond that, if you go for any other options, it will not give more revenue at all. Is that okay? Now find out the profit and loss for your mix. For the above mix, optimum mix recommended by you. Now find out the contribution. From the contribution, you can directly subtract the fixed cost. X, Y, Z. Units being 5,000 units of X, 1,500 units of Y, 4,000 units of Z. Contribution per unit being This one 25, 30, 25. Total contribution 1,25,000, 45,000, 1 lakh. What is the total contribution then? 2,70,000 rupees. Fixed cost for the company being 1,50,000 rupees. 1,20,000 will be your profit for this. Clear? Shall I move on to the next one? Clear? Now, question number 5. Limiting factor and optimum product mix. Z Limited makes 5 products to which the following standards apply: sales price, direct material, direct wages, variable production overheads, variable selling and distribution overheads. So these are the variable cost. Okay. Then total variable cost should be 38, 46, 60, 62, 78. Total cost, from that fixed cost is subtracted to get the total variable cost. This is total variable cost. Direct labor wage rate is 4 per hour. Fixed overheads have been allocation the basis of direct labor hours. Based on the direct labor hour, it is allocated. Company has commitment to produce minimum 200 units of each product per month, with a maximum demand of 1,000 units each product per month. So there is a minimum maximum demand also in the market. Okay. Direct hours cannot exceed 13,000. So from this it is very clear, direct labor hour being the limiting factor. Okay. So as direct labor hour being the limiting factor, now it's your requirement to calculate what? Contribution per limiting factor and decide among the 5 products which is the best one and rank them. Thereafter you can go for calculating the optimum product mix. Right. Let's start with the first one. A, B, C, D, E. Sales 50 rupees, 60 rupees, 70, 80, 90. Variable cost. How much is that? 38, 46, 60, 62, 78. And your contribution in this case being 12, 14, 10, 18, 12. Now contribution per hour, okay, per direct labor hour. Per hour 4 rupees. Direct wages information is given here. From this it is very clear. You can calculate the number of hours easily. You divide the direct wages by 4 rupees per hour to find out the hours. 16 by 4. So this is 4, this is 5, this is 6, 7, 8. So 4 hours, 5 hours, 6 hours, 7 hours, 8 hours. Direct labor are required. Now if I divide the contribution by the direct labor hour, then automatically what you will get? Contribution per direct labor hour. 12 by 4, 3 rupees, 14 by 5, 2.8, 10 by 6, 1.67, 18 by 7, 2.57, 12 by 8, 1.5. Now you can rank based on this available information. Among these contributions, A remains topper, B second topper, D third topper, C fourth, and E is the least choice. Right. So available resources can be used for manufacturing A alone, then B alone, then that's A, B, and then D, and then C and E. That's how you can go. Now I'm going to calculate the optimum product mix. Optimum product mix. Now, what is the available hours? $13,000 per month. In this illustration, we have been given minimum and maximum. So, from this, it is very clear. At any cost, you have to manufacture the minimum requirement. So, we'll finish up that first of all. Minus minimum to be manufactured. Minimum. How many units of A, B, C, D are manufactured? 200 units. 200 units of A, B, C, D, E. What is the total time required for manufacturing? 1 unit for A, 1 unit for B. So, otherwise, time spent for manufacturing 1 unit of all the 5 products. Then, the value being 30 hours. So, you are in need of 30 hours to manufacture 1 unit of A, B, C, D, E. Is that okay? So, if I multiply with 30, 6,000 hours has been utilized for manufacturing the minimum requirement of A, B, C, D, and E. Balance surplus 7,000 can be used for manufacturing the top ranked product to the maximum market demand. Top ranked product to the maximum market demand. Clear? The time required for A, B, C, D, E is 30 hours. If you have 30 hours, you can manufacture 1A 4 hours, 1B 5 hours, 1C 6 hours, 1D 7 hours, 1E 8 hours. Otherwise, 30 hours needed for manufacturing 1 unit in all. Now you need to manufacture 2 units in all products. A 200 units, B 200 units, C 200 units, and D 200 units, and E 200 units. Okay. This is nothing but minimum. All products are manufactured 200 units. Is that okay? Thereafter, top rank goes to A. I can manufacture A. So, maximum 1000 can be manufactured. The first we have completed, the minimum requirement 200. Still, we can manufacture how many units? 800 units. This one being all. 800 units for A. How many hours required? 4 hours needed. 3,200 hours needed. Out of 7,300, 200 has been used. Balance 3,800. Second tapper being B. How many units can be manufactured? Already 200 manufactured, maximum 1,000 can be manufactured, another 800 can be manufactured. 5 hours needed, 4,000, but there is a trouble. We don't have sufficient hour. Okay. So now you have to find out what is the maximum number of units can be manufactured. So we have 3,800. All the 3,800 hours going to be used for manufacturing only B. Reverse calculation. Come on, get this value. 760B can be manufactured. 760B can be manufactured. Clear? Now recommend your profit for the mix. Profit for the mix. For the optimum mix you have done. Optimum mix. Recommended in above calculation. So, first you have to start with the contribution. Contribution. A, B, C, D, E. How many units of A is manufactured? 1,000 units. Minimum already manufactured. Another 800 manufactured, so 1,000. B, already for the minimum requirement 200 manufactured. Surplus, we have the resources, so we produce another 760, 960. And C, D, E are manufactured only to the minimum extent 200, 200, 200. Is that clear? C, D, E are manufactured the minimum 200. A manufactured 200 plus to the extent of maximum another 800 also quite capable of manufacturing. So we manufactured 1,000. Beyond that, of course, we cannot sell in the market. B, 200 manufactured 760 also because of availability of resources we manufactured. And contribution being here is 12, 14, 10, 18 and 12. Find out the total contribution. 12,000, 13,000, 440, 2,000, 3,600, 2,400. What is the total contribution? 32,440. 33,440. Okay. Minus fixed cost to get the profit or loss. Okay. Now, fixed cost. Fixed cost. Fixed overheads have been allocation of the basis of direct laborers. This is based on the direct laborers. 4 hours, fixed overhead being 4 rupees for A. It means 1 rupee per hour. 5 means 5 rupees. It means 1. 6 means 6 rupees 1. So overall number of hours available being 13,000 hours. Into per hour being 1 rupee. So we decided what is the fixed overhead per hour based on the above information. And 13,000 into 1 rupee, 13,000 is the total fixed cost for the month. After subtracting that, the profit as per your optimum mix being 20,440. 20,440. Is that clear? Shall I move on to the next one? Try to solve all the book bag problems as well as past year's question paper in this chapter. Okay. I will schedule the practice session for the cost and management also now and then. Okay. Especially this cost and management, marginal costing. You can solve the illustration from the CA interbook, CMA inter group 1, CMA inter group 2. Even though if time permits, you can go for SEM book at your final level. Okay. So if you are able to cover those things, assured success will be there at your CMA group 2, because in CMA group 2 most of the students scared only with this topic, especially marginal costing. Management accounts itself, in that management accounts, especially marginal costing. Okay. I stood highest scorer in my cost and management paper in my study. Around 87 I scored. That too I completed my examination in the maximum less than 2.5 hours. Less than 2.5 hours I completed. Despite that, at my final level, I just saw the questions. I could answer all the questions. I could break the knock also. Immediately I started solving the illustrations without second thought. I was using the calculator a bit faster. So I use the left hand for calculator and right hand for my papers. And not even single minute for thinking whether the answer is correct or not. Despite of all these things, I could complete only 74 marks in the exams out of 100. What about the remaining 26? Yes, but time is over. Have I spent the time for thinking the solution? No. Okay. Have I calculated all these things using old and late calculator? No. Very fast. Despite that, so many calculations and so many things you have to break. See, especially this illustration. 7th question. And in order to make you understand the real toughness of this chapter, I have included this chapter sum also. See, 14th sum. It runs through this much of pages. 15th. Whenever I see this one illustration, okay, see, it runs through 3 pages. Page number 1, 2, 3. Immediately, I just simply think about my reading comprehension in my English exams. Whenever I start reading the reading comprehension, I start feeling sleepy. This particular 15th question, no, once you see this, you start feeling sleepy. But you have to answer this in 30 minutes maximum. 20 minutes question means you have to finish up in 30 minutes. If the question is for 16 minutes, 24 minutes, 1.5 marks per 1.5 minutes per mark. For the entire size question, it takes at least 2 to 3 minutes to read. Right. So to master that, I have solved this illustration included here. This is for CMA Group 2. Even may be applicable for final. Okay. How fast you solve? No, definitely takes at least half an hour. But during your practice session, try to solve all these toughest questions also. Of course, not required. This particularly 14 and 15 not required for the CMA Group 1 costing paper as well as CA Group 2 costing paper. But anyhow, take the challenge. It's also variation of the same topic. Try to solve this also. Go a step ahead of the requirement for your examination to score better mark. Right? Yeah. Now let's start with the next question. Elimination of your product. Elimination of your product. So we have completed indifference point, sales mix, limiting factor and optimum product mix recommendations. Let me move on to the elimination of product case. Elimination. Yeah. Question number 6. The company manufactures 3 products A, B and C. There are no common processes and sale of one product does not affect the price or volume of sales of other. The company's budgeted profit or loss for 2020 has been abstracted thus. So this is how it is given. From seeing this information, product A gives you 7,800 rupees profit, B gives you 23,100, but in case of C, that's a loss. So, as C being the loss making company, can we stop producing C? That's a question. That's a question. So, what will be the usual decision of the management? As C gives you loss, we have to stop producing C. By reducing the C, you can now make a profit of how much? 30,900. That last 900 is eliminated and the company's profit may be 20,000, 30,900. Like such a way we may make the decisions also. But absolutely making the decision by using this method is logically not correct. So to make the decision to stop one of the products to be manufactured or not, you have to depend on which method? Marginal costing technique method. So as per the marginal cost method, you have to first group the variable cost and group the fixed cost separately. Variable cost should be subtracted from the sales to get the contribution, and in total contribution, from the total contribution you can subtract the fixed cost, right? Here, by eliminating product C, will you be able to eliminate this 9,000? No. And sales and administration cost, this value 2,100 also be not possible to eliminate. That's a problem. I have a showroom with a sales representative taking care of that showroom. If any customer comes, okay, the showroom administration cost as well as salesman cost will be common, right? He just shows the product A, B, C. What are the product demanded by the customer? He can sell either A or B or C. If you stop selling C, still you need to have the same showroom, same salesman. Because of that, the showroom overall cost 60 cannot be eliminated. Okay. And overall salesman salary 2,100 and overall 6,000 cannot be eliminated. That's the problem. So you have to understand whether elimination of C will be really increasing your profit or not. You have to prepare the marginal cost sheet. Marginal cost sheet is nothing but the thing what we have learned here. Let's start with sales, variable cost, contribution minus fixed cost. You will get the profit or loss. For product A, B, C, even you can use the column for total. Sales being 45,000 and 2,25,000. Here 30,000. Overall sales being 3 lakhs. Overall sales being 3 lakhs. Variable cost being, you better club these two variable cost. 24 plus 81, 8,100, 3,200. 144,000 plus 8,100, 1 lakh 5,200 for C, 19,800. What is the total value? 2 lakhs 4,000. And what about your contribution? 12,900. 72,900. In case of C, 10,200, 96,000. And fixed cost 60 plus 6. You cannot calculate the fixed cost for each and every item independently. Whether you stop the product A sales or B sales, that fixed cost cannot be eliminated. The showroom cost is the same. In this statement, they have shared the showroom cost for A, B, C based on some assumed numbers. By eliminating, what happens now? The 60,000. If I eliminate the product C, this entire 60,000 will be now absorbed or taken by A and B only. No other way. Showroom cannot be eliminated. The rent and administration cost remains the same. Earlier, the showroom cost shared by 3. Now it should be shared. The entire 60 is shared by 2 products only, A and B. So 66,000. The profit being 30,000 rupees. Now, if you eliminate C, what happens? Contribution due to A being 12,900, B being 72,900. 85,800. What about the fixed cost? You cannot reduce the fixed cost by eliminating any other product. It remains same 66,000. What about your ultimate profit? 19,800. From this, it is very clear. As per the statement we have already prepared, if you directly see, C seems to be non-profit making or loss making. In order to eliminate that, you thought your profit will be increasing by 900 rupees, 30,900, but ultimately you are actually losing from 30 to 19,800. Clear? 30 to 90,800. Now, find out the difference. What is the decrease in profit? 10,200 profit decrease because of this elimination. So, not recommended. Profit decrease by 10,200. The profit decrease 10,200 is nothing but the contribution lost due to the elimination of this product. So, as you supposed to eliminate C, you thought only 900 rupees negative balance is going to be removed out. No, by stopping C, the contribution because of C is going to be lost, which is 10,200 rupees. Existing profit 30 is now reduced to only 19,800. The decrease in profit is due to elimination of C and contribution in it. Contribution in it. Remember, calculate the PVR. C bar S into 100. 12,900 by 45,000 into percentage into 100. Come on. 28.67 percentage. Next. 32.4 percentage. Next. 34 percentage. As per the PVR, product C is highly profitable one. B is the second profitable one. A is the third profitable. So the method what they have presented here, the statement presented here is called total cost method. Total cost method is nothing but taking the entire cost without classifying the cost into variable as well as fixed cost. Using the total cost method usually will be misguided only. For the decision making purpose, of course, fixed cost is not in your control. Whether you produce A or stop producing A, B or whatever it may be, you cannot control the fixed cost. So that's why in marginal costing, the fixed cost is termed as irrelevant cost. Irrelevant for the decision making purpose. As it is being irrelevant for the decision making purpose, forget about the cost. Our intention is to increase the contribution because I'm able to handle that one only. I can influence the variable cost only, means the contribution. Fixed cost is not under my control. So if I'm able to increase the contribution, ultimately my profit also be increasing. So to decide which of the three products better one, try to find out the most contribution generating product. Here, most contribution generating profit being C, not being A and B. So you can choose C. Clear? Hope now you'll be able to understand this question number 6. Make a note of it. I think question number 7 I need to discuss in detail. I'll continue in the next class. Okay. So in the next class, I will finish up